Tariffs, Trade Deficits, and U.S. Economic Strategy, Unintended Consequences and Global Implications. Summary Statement. The U.S. is implementing tariffs on its largest trade partners not as a direct solution to inflation, but as a strategic effort to address its persistent trade deficit. By reducing imports through tariffs, the U.S. aims to slow the accumulation of external debt obligations, particularly in the form of U.S. Treasuries held by foreign creditors. This approach seeks to mitigate the long-term fiscal burden of servicing this debt, thereby reducing reliance on the issuance of new treasuries and potentially rebalancing the country's economic position. Introduction. The implementation of tariffs on U.S. trade partners has become a hallmark of the nation's economic policy in recent years. While often framed as an effort to reduce inflation or protect domestic industries, tariffs are more accurately understood as part of a broader strategy to address the U.S. trade deficit, a key driver of the country's mounting external debt obligations. This exposition will explore the underlying motives behind the U.S. tariff strategy, analyze the immediate and long-term effects on both the U.S. economy and global trade, and highlight the potential unintended consequences of such policies. The core issue: U.S. trade deficits and external debt. For decades, the United States has run persistent trade deficits, importing more than it exports. This imbalance has led to an accumulation of external liabilities, primarily in the form of U.S. Treasuries held by foreign governments and investors. As the U.S. continues to borrow to finance its trade deficit, the interest payments on this debt become a growing burden, especially as interest rates rise. The U.S. government has historically relied on issuing treasuries to finance its deficits, which requires foreign nations to purchase these securities. However, this model of financing becomes increasingly unsustainable as debt obligations mount. By imposing tariffs, the U.S. seeks to reduce the amount of goods it imports, thereby decreasing the need to issue more debt and slowing the accumulation of foreign liabilities. In essence, tariffs serve as a tool for addressing fiscal imbalances by trying to lower the trade deficit, thus reducing the need to finance it through the issuance of treasuries. 3. The mechanisms of tariffs versus inflation. One of the most common justifications for tariffs is their potential to control inflation. However, the mechanisms through which tariffs and inflation operate are fundamentally different. Tariffs. By making imported goods more expensive, tariffs increase the cost of specific products in the U.S. economy. However, tariffs do not directly affect the broader money supply, which is the primary driver of inflation. Instead, they create price increases for targeted goods, often leading to higher costs for consumers and businesses reliant on foreign imports. Inflation. Inflation, on the other hand, is a macroeconomic phenomenon driven by changes in the money supply. When the central bank increases the money supply, usually through monetary easing or other mechanisms, this leads to an overall rise in prices across the economy. Inflation impacts a wide range of goods and services, whereas tariffs only affect a subset of imports. Thus, tariffs cannot directly control inflation, and their application as a tool for managing inflation is largely ineffective. Instead, tariffs are more aptly described as a tool for addressing trade imbalances rather than managing general price levels. Second-order effects of tariffs. The immediate, predictable consequences of tariffs can be observed in several areas of the U.S. economy. 1. Higher prices for consumers. Tariffs increase the cost of imports, meaning U.S. consumers and businesses will likely face higher prices, particularly in industries reliant on foreign goods such as electronics, automobiles, and raw materials. This raises the cost of living and doing business in the U.S. Domestic industry protection, short-term gains, long-term risks. While tariffs may temporarily protect domestic industries from foreign competition, the long-term consequences can be problematic. Reduced competition can lead to inefficiencies, lower innovation, and complacency among U.S. producers. Over time, these industries may struggle to remain competitive on the global stage. 3. Foreign retaliation. Countries targeted by U.S. tariffs often retaliate with their own tariffs on American goods. This could make U.S. exports less competitive and harm industries that rely on overseas markets. For example, tariffs on Chinese goods could reduce demand for U.S. agricultural exports to China, hurting American farmers. 4. Supply chain adjustments. Multinational corporations may shift their production away from countries subject to U.S. tariffs. This could create new trade patterns and alter the global supply chain, benefiting countries that are not targeted by U.S. tariffs, such as Vietnam, India, and Mexico. 5. Government revenue. While tariffs generate short-term revenue for the U.S. government, this comes at a significant cost to consumers and businesses. The revenue gained from tariffs could be used to offset some of the fiscal pressures faced by the government, but it is essentially a tax on the American public. This content is brought to you by Bobby Giggs. Promote your brand here and reach a wide audience across platforms like YouTube, Instagram, and Facebook. Follow the links in the description to get started. Third-order effects. Long-term consequences. The long-term implications of tariffs are more complex and can lead to significant shifts in global economic dynamics. 1. De-dollarization. Tariffs may accelerate the process of de-dollarization as countries that rely on exporting to the U.S. seek alternative trade arrangements. This reduces the global demand for the U.S. dollar, potentially weakening its role as the world's primary reserve currency. In turn, this diminishes U.S. leverage in global trade and finance. 2. Strain on U.S. alliances. Tariffs on close allies such as Canada, Mexico, and the European Union could strain diplomatic and economic relations. These nations may seek alternative trading blocs and partnerships that bypass the U.S., potentially undermining U.S. influence in global trade. 3. Global supply chain realignment. If tariffs remain in place for an extended period, businesses may further diversify their supply chains away from China and other countries facing high tariffs. This could benefit other emerging markets, but reduce China's central role in global manufacturing. 4. Reshoring and higher domestic costs. The U.S. may see some manufacturing return home due to tariffs. However, this process is likely to be costly, with higher wages, regulatory expenses, and the need for significant infrastructure investment. The result may be cost-push inflation, where higher production costs lead to price increases across the economy. 5. Geopolitical realignment. Tariffs could push China and other major economies closer together, leading to the formation of new trade blocs and economic alliances that exclude the U.S. For example, the expansion of BRICS or enhanced economic cooperation between China, Russia, and Iran could weaken U.S. geopolitical influence. 6. Pressure on U.S. Treasuries and interest rates. If tariffs reduce the U.S. trade deficit, fewer dollars will be recycled back into buying U.S. Treasuries. This could lead to reduced demand for U.S. debt, forcing the U.S. to raise interest rates to attract buyers, or putting pressure on the Federal Reserve to intervene in the bond market. Conclusion. In conclusion, while tariffs are often presented as a solution to trade imbalances and inflation, their real purpose is to address the U.S. trade deficit and slow the accumulation of external debt obligations. However, the implementation of tariffs introduces a range of economic and geopolitical risks, from higher prices for consumers to the erosion of U.S. global influence. As the U.S. continues to pursue this strategy, it is essential to understand the long-term implications, particularly the unintended consequences that could reshape global trade and economic alliances.